You check the silver spot price and it's down. Not a little. Enough that you feel that quick rush of, okay, this is the dip. This is my chance. So you open a dealer site or call a local coin shop, ready to finally buy. And then you see it. The physical price barely moved. Same high premium, same wide spread, same limited quantities vibe. That's the moment most people realize something uncomfortable. Spot price dropped, but physical silver didn't. If you like these simple story-style breakdowns that help you understand what's happening without complicated jargon, please subscribe. I make these videos for everyday US viewers who want to stay calm and informed when markets get weird, and subscribing helps you catch the next update before it becomes a noisy headline. Quick note, this is educational only, not financial advice. Now, let's talk about why this happens, because it's one of the most misunderstood things in silver. People think silver has one price. In real life, silver has layers. There's the paper reference price, what most apps call spot. And then there's the real-world transaction price, what it costs to actually buy physical silver in the form you want, delivered the way you want, with a seller who can restock after they sell to you. When the market is calm, those two prices stay close enough that nobody cares. When the market is stressed, they can separate. And when they separate, the first place you feel it is premiums that refuse to budge even when spot drops. Let me make this feel real with a quick story. Imagine you walk into a grocery store and see a sign saying, "Eggs are cheaper today." You're excited because you've been waiting for a deal. Then you get to the shelf and there are only 2 cartons left, and the store manager says, "Yeah, the price is lower on paper, but our next delivery cost is higher and we don't know when the truck is coming." That store is not thinking about today's sign. They're thinking about replacement risk. Physical silver dealers think the same way. A premium is not just a random markup. A premium is the market's way of pricing in all the messy real-world stuff that spot doesn't include. Fabrication, shipping, insurance, financing, inventory risk, and simple scarcity in the specific products people actually buy. When spot drops, you would expect premiums to relax if the pipeline is healthy. But if the pipeline is tight, dealers don't have room to lower premiums just because the screen price dipped. So why would premiums stay stubborn during a spot drop? Usually it's a mix of a few forces, and they tend to show up together. One big reason is replacement cost uncertainty. If dealers believe they might have to pay up to replace inventory, they'll protect themselves by keeping premiums high and widening spreads. Even if spot is down for the day, the dealer is asking a different question. Can I restock at these levels tomorrow, next week, and at what terms? If that answer is unclear, they won't discount aggressively. Another reason is that physical supply doesn't instantly expand just because spot fell. Physical silver is not like a digital asset that can be transferred at the speed of an email. Silver must be refined, fabricated into bars or coins, shipped and distributed through wholesalers and dealers. If refineries are backed up, if mints are behind, if shipping is slow, or if wholesalers are tight, the retail market stays firm even while the paper market wiggles around. Another reason is product-specific tightness. A lot of US buyers don't buy silver in the abstract. They buy 1-ounce coins, popular rounds, or certain bars. Those categories can get tight even if large wholesale bars exist somewhere in the system. That's why you'll sometimes see generic rounds with one premium and government-minted coins with a very different premium. Physical isn't one pool. It's a set of pipelines. Now here's the part that keeps people confused. Paper price can drop on selling pressure that has nothing to do with physical demand. Futures markets can move quickly because of positioning, leverage, stop-loss runs, and macro headlines. If the dollar spikes, if yields jump, if risk assets sell off, paper silver can dip hard, even if physical buyers don't change their behavior much. That's how you can get a spot drop without a physical discount. The paper market can be trading a mood. The physical market is trading availability. And in the US, you often see this play out in a very predictable way. Spot dips. People rush to buy the dip. Dealers get a wave of orders, and instead of lowering premiums, dealers keep them firm, or they even raise them, because that wave of demand hits at the exact moment replacement is hardest. The dip becomes a demand event. The demand event reinforces premiums, and suddenly spot and physical feel like 2 different worlds. Now I want to slow down and explain something important in a way that's easy to remember. Spot is a reference price, not a guaranteed retail price. A reference price can be correct for large financial trading, but still fail to represent what it costs to source real product at street level. That's not a conspiracy statement. That's just how physical supply chains work. So if you're seeing spot down, physical not down, you're not crazy. You're seeing a market that's clearing through terms instead of clearing smoothly through price. And those terms show up as a handful of behaviors that you can actually observe without being a professional trader. First, premiums stay high. That's the most obvious one. Second, spreads widen. That's when the dealer's buy price and sell price move further apart. Wide spreads are a sign of uncertainty. Dealers are saying, we'll transact, but we need a bigger cushion because the market is unstable. Third, availability stays thin. Products remain limited, backorder, or call for pricing. Even when spot cools off, the physical shelf doesn't instantly refill. Fourth, delivery times stretch. When you see longer shipping windows and slower replenishment, that's the pipeline telling you it's under load. Now, a lot of people ask, okay, but why doesn't arbitrage fix this? Like if physical is expensive, shouldn't sellers rush in and compete it down? In theory, yes. In reality, physical markets have friction: transport, insurance, financing, minting capacity, and timing risk. If the friction is high, the premium can persist. And when the premium persists, it's often a sign that the system can't instantly respond with fresh supply at the terms people assume. This is also why dealer behavior matters more than online arguments. Dealers don't get to debate theory. They have to survive the week. If premiums won't budge during a spot dip, it's often because dealers are seeing something upstream: tight wholesale supply, unstable hedging conditions, or demand that keeps hitting every pullback. Now, let's talk about what this can mean going forward, because this is the part most people miss. A spot drop with stubborn physical premiums can be an early warning sign that physical demand is stronger than the paper market is reflecting. It doesn't guarantee a breakout tomorrow, but it can tell you the dip is not clearing demand. If demand were clearing, premiums would soften. When they don't, it suggests demand is still sitting right there, waiting. And this is where the story gets interesting for retention, because the question becomes, is this just a temporary premium glitch? Or is it the beginning of a bigger separation between paper and physical? Here's how you tell without guessing. Watch what happens over the next few sessions after the spot drop. If spot stays lower and physical premiums finally start sliding, availability improves, spreads tighten, shipping normalizes, then the market is relieving pressure. That's the normal outcome. But if spot stays lower and physical premium stays stubborn anyway, that's when you're looking at persistent tightness. That's when physical is quietly saying, the paper dip didn't change reality. Now, let's keep this US focused and practical. Most Americans buy physical silver for one of two reasons. Either they want to hedge against inflation and uncertainty, or they want a tangible asset they can hold outside the financial system. If that's your reason, the price that matters to you is not just spot. It's your net cost to obtain real metal. Premium behavior is part of the reality. This is also why some people get trapped emotionally. They wait for a spot dip, then feel disappointed when premiums don't drop. They start thinking the market is rigged, and then they make rush decisions. Either they overpay in a panic, or they get so frustrated they stop paying attention altogether. And the market tends to punish both extremes, panic and boredom. Instead, I want you to treat stubborn premiums as information, not as an insult. Now, if you're wondering what creates stubborn premiums specifically in US retail products, here are the most common drivers in plain English. Fabrication bottlenecks. When demand rises, the ability to mint coins and fabricate bars doesn't instantly scale. Capacity matters. Wholesale restocking friction. Retail dealers rely on wholesalers in the wholesale supply chain. If wholesale is tight or repricing constantly, retail premiums stay firm. Inventory protection. Dealers avoid selling too much at thin margins when they fear they can't replace it. Demand that buys dips. When every dip gets bought, premiums don't fall because sellers don't need a discount. And sometimes, a simple psychological factor. When buyers expect a deal, they all show up at once. That wave of buying actually removes the deal. Now I want to connect this to something that keeps showing up in this niche: paper versus physical. Paper price can fall due to positioning and macro pressure. Physical demand can stay firm due to real-world needs and long-term fear hedging. When those two forces collide, the market doesn't always resolve it with a clean spot move. It often resolves it with premiums and terms. That's why your screen can say one thing while your checkout says another. And yes, global signals can matter too. If you see persistent signs that physical demand is stronger in certain regions, like meaningful price gaps and persistent premiums in major hubs, that can support the idea that physical tightness is not just a local US retail story. But even if you ignore all global signals, you can still read the US physical market through the simplest indicators: premiums, spreads, and availability. Now, I promised I'd keep curiosity alive until the end, so here's the one question I want you to hold in your mind as you watch the next move in silver. If spot keeps dipping, but physical won't dip with it, what does that suggest about real demand? It suggests the market is not clearing the way a healthy market clears. Healthy markets clear through price adjustments that bring supply and demand into balance smoothly. Stressed markets clear through rationing, delays, wide spreads, and stubborn premiums. That doesn't mean the world is ending. It means the pipeline is under load. So what should you do with that information? Not panic. The goal is clarity. If you're a physical buyer, focus on your real transaction price and your time horizon. If you're a paper trader, understand that paper can move on flows that don't reflect physical tightness immediately. If you're simply observing, treat premiums as the physical market's voice. Now I want to hear from you, because your real-world experience is part of the signal. In the comments, tell me what you're seeing where you live in the US. Did you notice spot drop, but physical prices stay high? What product were you looking at? Government minted coins, generic rounds, or bars? And are your local dealers stocked or still tight? And if this video helped you understand the difference between a paper dip and a physical dip, please share it with one friend who keeps saying, "I'll just buy when spot drops," and doesn't understand why that doesn't always translate into cheaper physical silver. Sharing helps the right people get into the conversation before the next move turns into pure confusion. The big takeaway is simple. When spot drops but physical doesn't, don't just stare at the chart. Watch premiums, spreads, and availability. That's where the real story shows up first. Disclaimer: educational only, not financial advice. Always do your own research.